Good afternoon, everyone, and thank you for joining us. Today I have with me Tom Naughton from Prusik Investment Management. Prusik are a London-based investment boutique that specialise in Asian stock markets. And Tom, despite his youthful looks, is an experienced investor in Asian stock markets. He runs the Prusik Asian Equity Income Fund, and the managers recently took the decision to stem inflows into that fund. It's had a very strong performance record and strong inflows since it launched around 3 years ago. So, Tom, thank you for joining us. Maybe if I could just kick off with asking you to explain in sort of simple terms what it is you're trying to achieve with the fund.
Well, in fact, the aim of the fund is very simple. Really what we're trying to do is put together a portfolio of stocks in Asia that have good fundamentals, that have strong dividend yields, that those dividend yields are sustainable and will grow over time. And we're also trying to buy these stocks at the right price to make sure that we can achieve attractive total returns. So from that regard, we're not wanting to take on a lot of cyclical risk, but really focus on the areas that we think can provide these type of stable long-term returns.
Okay. And why have you decided to stem inflows into the fund at this stage?
Well, as you said, we launched the fund about 3 years ago, and we've always said it's a limited capacity fund because we do quite a lot of mid and small cap stocks. About 40 or 50% of the fund is in mid and small caps. And that means there is a size beyond which we can't run the fund. And so late last year, the fund got up towards $800 or $900 million. And although we felt we could run the fund there, we knew that if it continued to grow too fast, we wouldn't be able to generate the returns we're seeking. And so we put on a temporary 3% charge onto the fund, which has had the impact of slowing inflows. And so now we're in a much more comfortable position.
Fine, so for good bona fide reasons.
Yeah.
Excellent. And in recent years, we've seen an increase in the number of overseas equity funds seeking income, and we've seen that in Asia as well. So there's a few players in that space. What would you say is the key differentiator for your fund versus the competition? What do you see as your edge in that space?
Well, I would say you're right. There is more competition, and I think we certainly take the view that making money and outperforming is hard, and it's never going to be easy. I think firstly to say that Asia is much more fertile than other markets because even though income investing has increased, it's still much smaller as a percentage of total assets than it would be in the UK or US. And the other factor is because the Asian markets are so large, and there's a huge number of stocks that we're not all fighting over the same names. But our edge, I think, is really we focus very much on valuation. We focus really on a small range of sectors, in particular infrastructure and consumer, so we can really get to know those sectors extremely well. And by, I think, following a very absolute return focused strategy, a very disciplined valuation approach, it means that we can always find opportunities that are mispriced.
Okay, fine. And it'd be very helpful, I think, for viewers to hear what your views are on global stock markets in general and Asian stock markets specifically in terms of the next 12 to 18 months.
Well, I think certainly when I look globally and more specifically Asia that I know better, clearly equities are re-rated and we're in this situation where there aren't really any particularly attractive assets, that bonds are expensive, a lot of equity are expensive and so on. And so it's certainly more difficult to find value than it was several years ago. That said, when I look at Asia, the valuations seem to offer a lot more upside potential. So Asia, if you look at its valuation on a historical basis, is in the bottom quartile of historical measures. In other words, it's been more expensive than this 75% of the time. And if we assume that history repeats itself, then you would expect to make good double-digit returns from these levels on a 2 or 3 year basis. When you look at our fund, our portfolio trades on a PE of just under 11 times forward earnings. It has a dividend yield of about 4.2%. I think that's very attractive in terms of to me, the portfolio is worth, our intrinsic value would be around 15 times for that portfolio. So we've got a good buffer, and we're continuing to enjoy a good yield on a portfolio that isn't that cyclical. So I think in an environment of very expensive or unattractive options, I think our portfolio stacks up pretty well.
Fine. The next question I want to ask about was just alignment of interest, and it's something that's very important to us here. Would you care to share with the viewers the extent to which you're personally invested in the fund?
Well, I think it is very important. In fact, part of the reason that we set up the fund at Prusik was to run our own money. And so our interests are absolutely aligned with our investors, and it means that we want to avoid losing money. And that's the first thing we think about, is how not to lose money. And also we want to make sure we constrain the fund size so that we can generate high returns. So I have just under £3.5 million of my money in the fund. I say that because it's published in the annual report anyway. And so, of course, if the fund does badly, that hurts me. And it means that obviously my focus on the fund is always going to be there, because it's not an academic exercise. If we didn't feel we could make returns, then we'd have to either close the fund or change the fund or do something else, because we're not just running the fund so that we can have another Asian equity income fund. We think it's genuinely a way of generating high returns over the next 5 to 10 years.
Yeah. Okay. Well, that's very reassuring. Thanks. And finally, if we can just finish off with a question about a particular stock or market or sector that you think looks particularly attractive right now.
Well, I think, despite the concerns, I think China looks very attractive, and it's not particularly to do with the overall index, but as a result of the extreme pessimism about China, it means you can buy extremely strong franchises at very attractive prices. And one of our biggest holdings is Beijing Capital Airport, which operates obviously the main airport in Beijing. It's the second busiest airport in the world, and it's really geared into a very attractive area of growth in China, which is tourism spending. And as China rebalances away from fixed asset investment towards the consumer, we are going to see more people travelling. And I'm very confident that in 5 or 10 years' time, we'll see more passengers travelling through the airport than we do today. And as they travel through, and as the Chinese population earn more money, they're going to spend more money. And that's a big area of income for airports, is the retail side. And so the overall picture is very attractive, and on a valuation side, you can buy the company at a 50% discount to construction cost, and if you look at regional multiples, the stock could rise 100% if it were to trade on the same multiples as other airports in the region. So you've got an extremely good risk reward buying a monopoly asset at half of what it would cost to build, with 100% potential upside. And that's the type of position that we like in China. So, I mean, that would be a good example of a stock we're very keen on.
Right, great. Okay. Well, Tom, thank you very much for your time.
Thank you.
Hopefully that will be of use to those who are invested in the fund, and potentially of interest to others who may have an interest in the fund at a later date should capacity become available.